Now, we talked about beta just a few minutes ago. Let me go over the concept of what it is. It's essentially a measure of risk for the stock, but it is based on the stock price. So it's measuring the volatility of a stock price over a period of time. It's a statistical term. You just need to understand the limitations of it. The period of time, whether it's a 3-year beta, 5-year, 10-year, will give you a different variation. So you need to pick the appropriate time period that you're trying to look at. And it is looking strictly at the movement of stock price. It's not making any commentary about the profitability of investments or anything like that. The measures for beta is if beta is equal to 1, then that's a scenario where the stock that you're looking at has average market risk. Okay, so the only stock, so it's the exact same risk of the market as a whole. This would really be an exchange traded fund or an index fund. So if you had a exchange traded fund which calculated the value of the Dow Jones, that would have the exact same movement or risk as the Dow Jones. If the beta of a stock is greater than 1, then it is riskier than the average market. Okay, so stock has higher than average risk. And examples of this would be like maybe a small mining company. Things that are not cash flow positive or have variable cash flows, they would have high betas. If the beta is less than 1, then it is a stock that has lower than average risk. And this would be probably something like a large bank. Okay, so these would be large blue chip companies, profitable, cash flow safe. They don't move around as much as the market as a whole. Okay, now there is a formula that's in the book that says the beta of equity is equal to the asset beta. So the equity beta is equal to the asset beta times 1 plus D over E times 1 minus the tax rate. Okay, so what does all of this mean? So D is debt, E is equity. Now asset beta is essentially unlevered beta. So you can say the two are similar. And equity beta is levered beta. Okay. Unlevered beta would mean it's the company has no debt. Okay. Because leverage is equal to debt in the terms of finance. Okay. I'll rewrite that. So the terminology in finance is that leverage equals debt. So if you have no debt, you are considered unlevered. If you're a levered company, then you have some debt. Even if it's $1, you are a levered beta. And logically what ends up happening is that you would expect that if a company adds debt, they become a bit riskier because now they got debt payments to make. There's a possibility they might miss it. So you can see by this formula, as you add debt, this number here, then the asset beta, the unlevered beta, would increase because the number in the bracket is greater than 1. So equity beta would be greater than asset beta. So the levered beta is always greater than the unlevered beta. Other than the fact when you have no debt, in which case it is the unlevered beta as well.